If you look at the market and you look at what we're seeing in home prices, what we're seeing in inventory, days on market, the share of homes with a price cut, the delistings of sellers not being able to find a buyer at their price point, when you roll everything up, we've seen a market that's softened. Objectively, this market has softened.
And this is rapid. This is rapid decline. I mean, I think it's also important to note that with these changes and softening in prices, people are panicking because they thought their mortgage payment would stay about where it was when they bought the house, and they're getting these new tax bills. They're getting these new insurance bills. They're like, man, and the repair costs, and they're quickly realizing this house might wipe us out. Let's say you bought in 22, 23, or 24, and you purchased a home without an inspection. Now, all of a sudden in 25 or 26, you go to sell that house. We're seeing sellers dumping 10, 20, 30,000 or more in their homes to sell it. You're really underwater.
To be underwater doesn't just mean that your home's worth less than you paid for it. It means that your actual mortgage is now more than your home's worth.
Right, which could be worse.
So you have a bit of a buffer usually because you have some type of down payment. And so to actually get underwater, you usually need, prices to fall.
Lance Lambert, thank you for joining us for your July housing market update.
Housing. Always so much going on in the market, especially right now.
Yeah, you're not kidding. For anyone who is unfamiliar with Lance, he is a housing market analyst, owns and operates a housing analytics firm, and it's called Resi Club. All of his links are below. He also has a newsletter. I highly recommend that you sign up for it. And I'm Todd Sachs. If you're new to the channel, I am a real estate broker, educator, and housing market commentator. So each month, Lance joins us here. We're lucky enough for that. We have a playlist on our channel. You can actually see how things have progressed, but he's gracious enough to come on our channel every month and talk about his research and what he's seeing, as he said, housing. So without further ado, let's dive into the data, Lance.
Yeah, I think one of the big things to talk about right now is home building. Since mortgage rates shot up in 2022 and we really saw the pandemic housing boom fizzle out, many home builders were able to keep sales volumes going by doing discounting through bigger incentives, right? The bigger mortgage rate buy downs. And so for a lot of these builders, they're doing temporary buy downs of like 1.99, 2.99. Some of them are doing 30-year fixed of, 4.99.
Wow.
Average 30-year fixed mortgage rate to like 5.49 30-year fixed. But what we've seen recently is that some of the incentives that they were doing before the past few years to keep sales going haven't been enough to move the needle. And so many of these builders have had to make a decision. Do we do even bigger buy downs and incentives? Or do we pull back on sales? Or do we do outright price cuts? And I think depending on the builder you talk to, you're seeing a little bit of all those levers being pulled at the moment. And what we see in the data, and I'll show my screen in a moment. So we are seeing in the market an increase in the number of completed unsold homes on the market. And so if you look at the numbers right now, we have the highest number of homes, single family new builds that are completed and for sale. It's 119,000. And that's the most since 2009. And at the height of the pandemic housing boom, when everything was red hot and builders were just selling everything they had, there was maybe 20, 30,000 completed unsold single family homes in America. Right now it's 119. And so if you adjust that for the amount of homes that are being started, housing starts as a share, you'll see that it's not quite as high as 2009, 2007, 2008, when the market really broke, right? But this is the softest level that we've seen for new construction post GFC. So this is a 10-year, this is the softest moment in 13, 14 years for single family construction. And so we definitely are seeing more slack in the single family construction market. And we are seeing that unsold completed spec inventory in pockets of Texas, area like San Antonio, Dallas, uh, Austin, markets in Arizona like Phoenix, pockets of Colorado around Denver, areas in Florida, Jacksonville, Orlando, Tampa. Is you go southwest Florida, down to Naples, Punta Gorda, Sarasota, all those areas have seen a buildup in the completed unsold spec inventory. And
Now,
so
Lance, before you go any further on that, to change that slide, we have a lot less starts than we had back in the '07, '08, '09 as well, right? I mean, so that would be one of the reasons why. I mean, we're looking at a very uh, high level of unsold built finished inventory, but we're comparing it to the '08 crisis, we have nowhere near as many starts as then as well, right?
Well, how the math works is if right now the number of completed unsold builds just stays flat and the number of housing starts were to fall 20, 30%, this metric would swing up a lot, right? And that's a good thing for this metric in terms of being a valuable metric, because if we saw starts go down 20, 30% overnight, that's telling you that something very bad just happened in the market, right? And so this index, Resi Club's finished home supply index, would pick that up. And so right now it's telling us that anything that's in that dark green is in the 20 in the historically soft window, right? So of 20% of the time we are in that dark green. 50% of the time we are in historically normal. So almost all the time you are on this historically normal level. And then 25% of the time you're in that historically tight window. And that's the years leading up to, that's like 2001, 2003, 2004, 2005, right? And then really just super tight 2021, 22, early 22, right? And so, it is important that we've swung up into this historically soft window and we're continuing to push up. And if we did see starts pull back even more, you would see this number spike up into the 20, 25% range if starts really pulled back.
And common sense would say that they will pull back, right? I mean, if they're not selling the inventory and it's sitting there, and a lot of these builders, these home builders, this inventory wasn't necessarily meant for speculation. It just ended up that way. They were contracts, a lot of them that had fallen through, and they just kept building the house anyway and hoped that they would have it for a quick delivery. So would you expect that we would see this pullback of starts? Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I've even made a way for you to gift this course to your family and friends. Visit saxrealty.education. The link is also pinned in the comments below. Now back to the show.
I think we're going to see a softening of starts, and we've already started to see it. We've started to see a softening for single family permits, single family starts, and then even single family completions. And I think we're going to see more softening there too. Now, the question is, how much of a pullback do we see? And that's kind of where we have the discussion, right? Is it a really big, the 20, 30% pullback? Are we talking like a 5 to 10% pullback? And I think that's kind of where the discussion is at the moment. And the industry and builders are trying to figure out. Now, when the builders talked to Wall Street analysts over the past couple of weeks, because we just passed through builders' earnings seasons, a lot of the builders like DR Horton said, hey guys, we are spending more on incentives, but, and we do expect, you know, to spend more on incentives in the second half of the year, given the softening, but we're not seeing a greater softening than we've already reported. And that was kind of a theme throughout a lot of the builders' earnings calls where they're like, we're spending more on incentives. Maybe some of us are pulling back a bit on starts, but you know, the softening is kind of manageable. That's kind of the story they've given Wall Street. Then well, just recently, on I believe the last day of July, Builders First Source CEO and Builders First Source, you know, they're a giant Fortune 500 company. They're worth $14 billion. They are the largest supplier of building materials in America. They came out and said, we actually think it's a bit worse than what the publicly traded home builders are seeing. And Builders First Source said they expect a bigger pullback in starts is based on what they're seeing on the tea leaves. And you know, and now one thing to point out about Builders First Source and building supply material companies is that they aren't just doing single family, they're also doing multifamily. And in the multifamily market, you are seeing even a greater pullback in the number of apartment units hitting the market right now. So, what happened is during the pandemic housing boom, when there's all these ultra low rates, you get all these syndicators raising money, right? There's a lot of money flowing into multifamily. And a lot of these projects were financed. And so a lot of the projects that were financed for multifamily in 2021, 2022, they hit the market in 23, 24. And so 2024 saw the most multifamily apartment units hit the market since 1974, the year Richard Nixon resigned. So it was a very big apartment boom that went into the market. We're through that though, right? And so the past 2 years, we've been seeing a rollover in multifamily permits and multifamily starts. And finally, in 2025, we are seeing the rollover in multifamily completions. And so, why does multifamily matter? Well, multifamily matters because residential construction is a big piece of the economy, right? It's around 5% of the economy. And it's also one of the parts of the economy that is more, a lot, it can go up and down more, right? And so when you see residential construction's contribution to the economy pull back a lot, that's usually a period where we're going into a recession. And so at the moment, we aren't seeing a big decrease in the number of people that work in residential construction, but you are starting to see it roll over. And so if you look at this chart, the first one is residential building construction employment. And this is a very well cited, very covered among economists. And residential building construction employment, a lot of those are builders, general contractors who oversee the management of the entire construction of residential structures, right? For single family townhomes, apartment. But residential specialty trade contractors, right? The contractors, those are the biggest chunk of the employment for remodeling and construction. And that's the one that's rolling over now. And we have not seen a rollover in specialty contractor employment uh, since the one that started '06. So we are starting to see a rollover. Now, the pullback to this point isn't that big, but it's notable that it's softening. And historically, the specialty trade contractors employment doesn't go back before 2001. But if you go back and you look at residential building construction employment, which goes back to the 80s, historically, when it starts to roll over, it leads recessions by months, 6, 12 months usually. It happened for the 2001, it happened for GFC. And so it is notable we're starting to see a reduction in the employment contribution that comes from housing. And I think that's a tea leaf that suggests that the overall economy it is slowing at the moment.
Yeah, I saw that with the new BLS reports. for July, where specialty contractors were year over year a big negative number. So yeah, and being in this industry in the trades, I see it too. I mean, I talk to a lot of people, and my phone rings with people saying, "Do you know of anyone that needs work or is looking to have something done?" So I'm starting to see where the impact is real.
Yeah, and if anything, I think when I talk to people throughout the industry, if anything, what I hear on the ground suggests a greater softness than what we're seeing in the aggregate data. Now that's been true for a while now, but it is notable that we're starting to see it also in the aggregate data to roll over for the contractors.
Yeah. When we're talking about, the National Association of Realtors just came out and said that we had year over year average price increases or median price increases. Can you just explain to people, Lance, what that means? Because we're seeing prices coming down
Yeah,
on a lot of listings, but I think people are confused. They hear this data in the headline news and they say, well, prices aren't coming down. I mean, can you kind of explain they hear it from me, but let them hear it from you, a data analyst. What are they looking at when they see median home price or average home price?
yeah. So a lot of these different indices and measurements for housing, they're a proxy of what's going on in the market, right? And so there are 6 to 7,000 stocks listed on US stock exchanges, right? And so on any given day, Monday through Friday, when it's not a holiday, you pretty much know the trading rate that your stocks are going for, right? You know what the market is for those. In housing, there's around 100,000 or around 100 million units, right, for housing. And a lot of these homes and units, they have a lot of nuance to them, right? And you could have in one part of the country seen something very different than another. And then within that part of the country, if you go into the better school districts, you might see something very different than you see in the deep exurbs, right? And different product types can see something different. And so these different indices and different measurements, they're all trying to give us a proxy of what's going on when you roll everything up across the country. And so the median is just taking that middle number, and the median and also the average can get skewed a lot by mix shift. And so if you have something like you did during GFC, which is the entry level bottom of the market just completely blew out, and single family entry level building was on life support. And so some of the builders who stayed alive, stayed in business, some of these custom builders, they went to bigger builds. Not that the bigger build part of the market and those luxury homes was hot. It wasn't hot. It was down too, but it was just that that's where they could find a little bit more juice. And so if you look at new home prices through GFC, they fell, but they didn't fall as much as the real world reality that it had happened because the mix of the transactions skewed to the bigger end. And so that sample size didn't fall as much. And you can have it the other way too, where in some markets where if at the top of the market is cooler, and so more of the transactions are at the bottom of the market, it can skew it the other way, right? And so these averages and medians, they get skewed a lot by mix shift. I like to use the ones like the repeat sales indices, Case-Shiller, Freddie Mac, uh, that are taking, they have a methodology that is looking at repeat sales. It has flaws too, but I kind of like it for kind of getting out some of the noise and mix shift. But all of these at the end of the day are a proxy. And so if you look at the market and you look at what we're seeing in home prices, what we're seeing in inventory, what we're seeing also months of supply, which is also inventory, days on market, the share of homes with a price cut, the delistings of sellers not being able to find a buyer at their price point. When you roll everything up, we've seen a market that's softened. Objectively, this market has softened. And the longer we've stayed in this affordability constrained environment, that supply demand equilibrium has shifted more and more in more parts of the country from sellers to buyers. Now, are there still parts of the country in, let's say, the Northeast, the Midwest, where, there's, prices have kind of held a little firmer and even in some of these places gone up a little bit more? Yes, those places still exist. Although some of those places are starting to see a little bit of softening too. Nothing too crazy at this point, but seeing some softening, some inventory build, some deceleration and price appreciation. But as you go through a lot of these Sunbelt markets, right, pockets of Tennessee, Nashville, Memphis, you go into pockets of Texas, you go into pockets of now Alabama, Georgia, North Carolina, South Carolina, obviously, notoriously, a lot of these areas of Florida, some of these areas in Arizona, you've seen a lot more softening and just outright weakness. And if you look at the data and some of these indices, you are seeing prices fall in places like Phoenix, places like Austin, San Antonio, parts of Dallas, uh, Tampa, Cape Coral. Now in Miami, you're starting to see greater weakness and softening there. And so I think if you just look at that headline number that gets nationally reported, you might find a reality, or you might have a misinterpretation of what the actual reality on the ground in your market might be. And so the things that I would suggest looking at is trying to find some different indices that are measuring your market and look at them over time. I would also recommend looking at active inventory. Where is active inventory now in your market versus 2022 versus 2019? And really that comparison to pre-pandemic 2019. And so the markets that have gotten closer to 2019 inventory levels, I will see some agents or investors when I publish that number, and they'll be like, well, 2019 was a good market, right? Prices were going up. It was a healthy market. And and so they're kind of skeptical why a 2019 level inventory would suggest softness, would suggest weakness. And the thing that I would tell them is, and I would tell anybody, is that yes, 2019 levels of inventory are nothing crazy, but to go from the very bottom levels of inventory ever and shoot all the way back to 2019, that bend up, right? That velocity of that change, it means that supply demand equilibrium has shifted a lot towards buyers. And so if you see a market where inventory has gone up 200% to climb up to 2019 levels, that's a market where you probably felt a lot of change on the ground. There's been a lot of that softening. And so I think that's very much where this market is. It's a market that is coming out of this overheating during the pandemic housing boom where prices went up 40, 50%, 60, 70% in some pockets of the country. Then mortgage rates went up 3, 4, 5, 6, 7%. And incomes didn't keep up to that, right? Incomes would have needed to increase 80% to match that. And so this affordability strain is just pulling this market down and holding this market back. And we're going through this period where some of the parts of the country are passing through outright price corrections. There's this recalibration. The market is essentially trying to heal, right? The market is trying to heal from that imbalance, right? That very big overheating during the pandemic housing boom period. And I think that's the way that I would describe this market today.
Yeah, well, that's well said. I think also it's important to say that in 2019, we were headed into recession. And I think that in a lot of ways, the stimulus that came in 2020 sort of kicked that can down the road. Um, but I agree with everything that you're saying.
Can I show some hard numbers here?
Sure, sure. Yeah.
So back in January, 31 of the nation's 300 largest housing markets, so 10%, were down year over year for home prices using the Zillow Home Value Index. So 31 of 300 down year over year in January. In February, that went up to 42. And so that was 14% of the market. And so right around here or into March, we had a discussion and we had a chat, and I had said, I think we're going to around 150 markets down year over year. And we've continued to see this move up. So in March, 60 of the nation's 300 largest markets, 20%, had falling year over year home prices. In April, it was 80 of 300, so 27%. In May, it was 96 of 300, 32%. And in June, it went up to 110. And I expect another increase when we get the July numbers in another week. And if you just look at the 50 largest markets, because one of the things about the 300 largest markets is it ends up getting a bigger disproportional pull to like the Midwest, where there's a lot of this really the smaller metros, right? Kind of dot the Midwest, the Youngstowns, the Akrons, right? Toledo's. And if you just look at the 50 largest, 50% of markets are falling year over year of the 50 largest. So 25 of 50. Whereas at the 300, it's 36%. And so when you look at the numbers of the 50 largest markets in the country, you have places like Austin, Tampa, Miami, Dallas, Orlando, Phoenix, San Francisco, San Jose, Jacksonville, Florida, Atlanta, Denver, San Diego, Raleigh, Sacramento, Houston, Riverside, California, New Orleans, Charlotte, Memphis, San Jose, Portland, Oregon, Seattle, Los Angeles, and Birmingham, Alabama. That's a lot of big markets that are down year over year. Now, we're not necessarily talking about, 2008 level declines year over year, but, that's softening, right? And if the indices are showing declines of 3, 5%, 6%, on the ground, it's gonna feel a lot softer than that maybe those numbers would have you think.
And this is rapid. This is rapid decline. I mean, when you're talking about these markets falling, I mean, you're giving month over month, talking about April, May, June. I mean, you're seeing where more markets are declining, and that is a significant change. And I think it's also important to note that with these changes and softening in prices are also coming sellers are spending they need to spend money. You're seeing now home inspections where we didn't see that 2 and 3 years ago. We're seeing sellers dumping 10, 20, 30,000 or more in their homes to sell it. I would just spoke with a lady that wants to buy here in Maryland. Her house in North Carolina fell through. They just spent tens of thousands of dollars on improvements. It still didn't keep that buyer into their contingency period. They walked out for many different reasons, not just the condition of the home, but the inspection process revealed so many things that they had to make a decision and say, look, if we don't disclose these now, and we need to fix them. And so we're seeing where sellers are spending money where they hadn't had to do it, Lance. And that compounds this softening even more. And before, just let me say one more thing about that. And I like the fact how you said active inventory. What I like about what you do is you're analyzing and really staying focused on active inventory numbers and what's happening with that data set, because real estate is so backward looking. If you buy something today, you're not closing on it for 30 to 45 days. And so we can't rely, it takes so long to get those numbers to see the further trends, but you're relying a lot on active inventory, which I think is great.
And you hit the nail on the head there, Todd, which is that's what I mean in terms of like when you see a number down 3, 4%, even 1, 2% year over year for a market, which usually home prices don't fall, right? Home prices usually go up. That's historically that's where they drift. So when they do fall 1, 2, 3, 4% year over year, on the ground, it's going to feel a lot softer than that. And some of the declines are falling into things that might not be on that final sales price that goes into the auditor, right? Maybe it's the things like the incentives, right? And some of the actual existing sellers are copying the builders and doing some of their own incentives, right? It could be, like you said, having to spend $20,000, $30,000 remodeling the house, right? Getting it to top condition, all of those things can actually be real economic falling prices that don't get calculated into here.
Obviously, Trump is telling the news media, or at least he's saying it directly to the American people, that we need Powell to reduce the Fed rate so that people can afford their homes again. I don't think it works that way, but it sounds good. It certainly puts a lot of pressure on Powell. I just spoke with a applied economics professor at Hopkins. He's on our show a lot, Steve Hankey. He says that if the Fed cuts the Fed rate, we're going to see an exact opposite effect in mortgage rates. He almost assures that if the Fed drops the rates, we'll see an increase. We did see that in the last rate cut. We saw mortgage rates actually bumped up. What are you thinking as far as the mortgage rates? Do you see where we'll come into a softening of the 30-year fixed rate mortgage? You think we'll kind of stay where we are, or are you expecting any type of rate increase?
Yeah. So with the long term side, the Fed doesn't like, and you know this better than anybody, which is that the Fed doesn't set the long term rates, right? The long term yields. The Fed sets the short term rate, right? And when the Fed, and so those long term rates, so what really is moving it, right? And so what is moving it is the underlying demand for mortgage backed securities. And so bonds and yields, they move inversely. And so if there's a lot of demand for 10-year treasuries or for mortgage backed securities, there's going to be a lower yield, right? And so when the Federal Reserve in 2021 is going out buying mortgage backed securities hand over fist, that's putting upward pressure on the demand for the mortgage backed securities, and it's putting downward pressure on mortgage rates and the yields. And so when the Fed pulled back and they stopped buying mortgage backed securities, that added a little bit of additional pullback in the demand for them, right? And so, or well, more than a little, right? And so they go from buying a ton to not buying at all. And there wasn't a natural buyer who stepped in to start buying the mortgage-backed securities. And so then, because the yields and the rates move inversely, that put additional upward pressure on mortgage rates. Now, there's a lot of other things that went into pushing the mortgage rates up, of course, and including inflation expectations and all of that stuff. But the Fed, and the demand for the mortgage-backed securities is a big part of this, right? And so if the Fed were to cut the short-term rates, you could see potentially some decrease in the long-term rates, but it really kind of comes down to what is going on in the overall economy. If the Fed tomorrow comes out and cuts rates, but the economy doesn't soften as much as as expected, right? It could potentially have the opposite effect, right? It could put a little bit of mortgage rates might not fall like people think. Now, if the Fed were in the next 2 months to come out and do a emergency 100 basis point cut of mortgage rates, and the unemployment rate were to spike and there were to be a break in the labor market, I do think mortgage rates would fall. But that's because you would see some of this flight to safety in the market where investors are like, "Oh, wow, what is going on in the stock market? What is going to happen to my job? What is happening here?" And you see this flight to buy, you know, these these safer bonds, right? And so the demand for bonds goes up and the yields go down. You could see something like that, but it really comes down to what is the overall economy doing. It's not as simple as the Fed snaps their fingers and mortgage rates are down, right? There's a lot more nuance to what's going on in financial markets and the bond market.
You mentioned earlier in the podcast, and we've talked about it before on our show and with you, that builders are finding where the mortgage buy downs aren't necessarily giving them the results that they want. They've been buying down mortgage rates, 4.99%, 5.5% fixed rate mortgages for several years now. I know they had a very bad month of reporting, October 2023, some of the lowest sales numbers. And despite that, buy down. If we're hovering right around that 7% rate for a 30-year fixed rate mortgage, where would you suspect that we would need to be in order to stimulate the kind of growth that sellers would like to see to keep these prices from falling?
So the builders have found, going back to 2023, some success with the buy downs, right? Some of the temporary ones, 123, where you start out at 199 or 299, and then it kind of drifts upward over time. Or, the builder does the 30-year fixed full, right? For, you know, 549. And so based on my research, for them to go down to 549, so pretty much 5.5%, right? You're looking at, I believe it's 4.5%. So let me do the math here. So you're looking at about 23,000 the builder's got to spend for that buy down, and then to go
For
down
what priced home? For what priced home?
on a 500,000.
500,000. Okay, got it.
And for 499, I heard that it was around 7%, so around 35-40,000 potentially.
Got it.
Now, if you look at what Pulte Group said on their earnings call, is that in a normal market, they're doing around 3 to 3.5% sales incentives, because builders always kind of have a little bit of these sales incentives, right? It's kind of built into the price. And in Q2 2024, their sales incentive rate was up to 6.3%. And then as of Q2 2025, it's up to 8.7%. And keep in mind, of the publicly traded builders, Pulte Group has one of the lower sales incentives rates right now. And they actually have one of the better gross margins. Lennar's spending 13.4% on sales incentives. And so they have gone up to bigger incentives. They're trying to juice it up to kind of keep sales going. Now, earlier, if you go back to 2023, when you have bigger incentives, sometimes that can be a price cut, sometimes it might not, right? Because what the builder could do is, well, if they're spending 30,000 more in sales incentives, but the price goes up 30,000, that's not really net incentive, right? But if your price was 500,000 and now you're having to pony up to spend 30,000 in sales incentives, that's net effective. And so some of the builders had continued to raise prices in 2023, early 24, and they were then taking some of that or most of it and putting it to incentives, right? So baking it into the price. Lately, you're seeing more of it's just outright net effective price cut where they're just having to pony up more in sales incentives and that price isn't rising, right? That sticker price isn't rising. And so that's more net effective. And then some of the builders in some of these markets are having to do outright price cuts on top of the sales incentives to move product. And when some of the things to keep in mind if you're a buyer is KB Homes COO recently came out, and KB Homes is one of the 10 largest publicly traded builders. And unlike a lot of their peers like Lennar and DR Horton that love these mortgage rate buydowns, KB Homes, they prefer to do outright price cuts when they have, when you have a market that's shifted. And one of the things that their top executive or one of their top executives warned is that buyers who overpay on price to get these bigger incentives, they could find themselves underwater if they have to sell in the short term in the next couple of years. Because if you're in a market where you overpay and the market flips down, right, falls, then, that down payment could quickly blow off, right? And that equity buffer could very quickly be gone. And so I think that's one thing to keep in mind with the incentives. And so why do builders like to do mortgage rate buydowns, like to do these incentives? One is they're trying to protect comps for their community, right? Because if you're lowering the actual comps that people see, that could affect future sales, right? And then the other part there is that you could upset the people in your backlog where, Johnny paid 500,000, he sees Susie come in and pay 450,000, he's not happy, and and maybe he walks. Maybe you only had him do a 3% earnest money down, right? Or even some of the builders, 1%, right? And he's like, you know what? Keep my money. I'm not doing this. I don't want to overpay and be a
I'd
son.
I'd lose it's like driving that new car off the lot. If I keep staying this contract, I would be better off breaking it, losing the money, and renegotiating with you on my new home price than I would staying in the deal. Yeah,
Exactly. And so that's why the builders like to do it more discreetly. And so Johnny doesn't know that that's the case because Susie's getting a lot more of her cuts in other areas, right? And so that's one of the reasons. And then another reason is there is actual arbitrage in financial markets right now, given where, and this kind of gets a little complex with the long end of the curve and the short end of the curve. But essentially, in this market we're in right now, a dollar spent by a builder on buy downs creates a greater overall payment savings to the buyer than a dollar for price cuts. Now, that's not to say the buyer shouldn't be out trying to get the price cuts. Me personally, that's what I would want.
me too.
And I'm not here, I don't give financial advice, but that's, what I would be pushing for personally. But the builder from their end, you know, they can create a greater payment savings for every dollar spent on buy downs versus outright price cuts. And for a lot of buyers, they're looking very closely at those payments. And that's, I mean, a lot of these buyers in this market the past few years, they've been barely just eking into the market based on, the payment they can afford in this affordability strained environment.
Well, it's like you said, if you go for the higher priced home to get the better interest rate, should you need to sell in the next 5 years or 7 years and we go into some type of continued downturn with price or just even flatten out with stagflation, there is a cost to selling a home. And they say that you need about 10% equity to come out of it with what you paid for the home. So a lot of these home buyers, and we showed it in our last uh, podcast together where you had the slide. I don't know, maybe you could pull it up easily, showing the different years and the amount of loans that are underwater or could be underwater. But is that an easy slide to find?
I could get it real quick if you give me a
Yeah,
second.
I mean, I thought that was very interesting because a lot of people, they what I hear a lot is, "Oh, yeah, just wait a couple more years, you'll have missed out on all this opportunity, and home prices only go up, and you listen to what these people are saying about a price correction or things coming down, you just missed out on a lot of equity." These are things that people comment. They're really ignorant comments, and I don't mean it in a nasty sense, but they don't know. Ignorant, like the true sense of the word, the definition of the word ignorance. If you look at the data and you say, okay, if I bought at the highest price or the peak, which I say was in 2022, you could lose money or not have, you'd have to come to the table to sell your house.
Yeah, and so what we're seeing right now in terms of number underwater, 1%. Or nationally, it's 1% right now, so it's still fairly low. Even though some of these markets, 30-40% of markets are below their 2022 peak, and the reason is, of course, to be underwater doesn't just mean that your home's worth less than you paid for it. It means that your actual mortgage, right, is now more than your home's worth, right? So
Right.
you're
Which could be worse.
so you have a bit of a buffer usually because you have some type of down payment. And so to actually get underwater, you usually need prices to fall more considerably, right? That double digit level decline. Now, what you're seeing in some of these markets that have seen that material correction, Cape Coral, Lakeland, Florida, San Antonio, Austin, you're starting to see the overall numbers underwater go to 3, 4, 5, 6, 7%. But the vintages of 22, 23, 24, some of those are seeing a quarter, of the people in those vintages in the markets that have seen more of a material decline find themselves underwater. And like you had mentioned, is just because you're not underwater, if you're borderline underwater, once you have, you do the transaction and you pay the transaction cost, you were effectively underwater, right? it's at a
Yeah.
loss.
And let's go one step further. Let's say you bought in 22, 23, or 24, and you purchased a home without an inspection. So the seller was able to sell you that house for top dollar without making any repairs. Now, all of a sudden in 25 or 26, you go to sell that house. You've either spent money fixing the things that you've discovered are wrong with the house, or the next buyer coming along is not willing to buy like you did in 22, 23, and 24 in these numbers. And they require you, in order to sell the house to them, to fix things like we were talking about, spend 10, 20, $30,000 on repairs. You're really underwater.
And so I think a few of the things that people can do in this type of market is one, if you're going to buy, I think a longer horizon, right? If you're a short-term buyer, that's the people that the 22, 23 might find themselves in a choppy situation, right? Where they bought and they decided to sell in 2 years, right? Some of them are going to get themselves in a pickle in some of these markets. So really thinking about, how long do you want to hold this, right? And then the other part there is, doing your research and like you had said, making sure that, not being rushed into a decision. And in this market where, inventories build up, days on markets moved up, you have more negotiating power. I think that, you have more of that wind to your back, right? Helping you, right? To have the time to make that decision and to, make a decision that actually works for you long term. And then going back to the comment about the builders, if you get that reduction through the buy downs, and then let's say we have a recession or whatever occurs and mortgage rates come down, you're not going to see the benefit of that potential refinance, right? And so I think that's one thing to keep in mind. Whereas if you try to get more of the price cut through outright prices, right, you could potentially benefit if there were a window of refinancing. And I do want to be very clear. I'm not saying that I know there will be a window of refinancing. I'm never one of those ones who's pushed, you know, marry the house, date the rate, because at the end of the day, nobody knows where mortgage rates are going, right? But I'm just saying that it's still in the possibility. It's still in the cards, right? It is some of the things that I would consider if I were out in the market today.
When lenders mention that, date the rate, marry the house, it is such a disservice to the homeowners, because it sets them up, to the buyers, because it sets them up instantly for failure. What they're saying is, your house, if the price doesn't fall and it goes up, it increases in value, maybe you will be able to take advantage of a refinance if the interest rate falls enough. And because there's a cost to refinance, you have to reappraise your house. And if it did fall in value or stayed flat, you may actually have to put more money down on the principal balance and finance less in a refinance, and you don't have that extra money. And yeah, I mean, if the prices soften and fall and you start seeing these new comparables hit the subdivision, your neighborhood, all of a sudden your neighbor sold for $30,000 less for a similar house, that comparable is now going to impact the appraiser's decision on how much they appraise your house for. And then if you put 3% down and that's the type of loan you're going for, you're going to need even more cash down. So they don't explain all of that. And going back to your point of the people moving, what I've been seeing with a lot of people that want to sell their house, they bought it 2 and 3 years ago, even a year ago. I mean, I'm seeing crazy stuff where I just looked at a particular property in Tennessee for somebody. They were asking me about it. They bought it a year ago, and now they're wanting to sell it. And I'm saying, this is, you want enough money to come out so that you don't lose any money, but it didn't increase that amount of money in the last year. But people are panicking because they didn't realize that their mortgage payment they thought their mortgage payment would stay about where it was when they bought the house, and they're getting these new tax bills. They're getting these new insurance bills. They're like, man, and the repair costs, and they're quickly realizing this house might wipe us out financially. And so unfortunately, that the exuberance that we witnessed over the last 5 years of these buyers, especially first-time buyers, man, they were really misinformed and they let their emotions get away from them, Lance. You know that.
So you're spot on in terms of these echo shocks, right? So usually what happens first is the overheating and prices. So prices lead, right? And then what comes after is the echo, right? And that's insurance and property taxes. Insurance in a lot of these places comes in a little faster depending on the state. You do have states like California where they fight a lot of the increases, and it takes time for that housing inflation to come over into insurance. And so you're probably and so some readers might be like, well, if housing prices and home construction uh, prices go up a lot, why does insurance go up? It's cost of replacement, right? And so when those homes are damaged or whatever, right? If the that housing inflation is shot up and home construction inflation is shot up, if there is, that home needs replaced, damages, whatever, the insurance, they're going to have to pony up more. And so a lot of these increases in insurance that we've been seeing across the country, yeah, some of this can be due to some of the models for climate risk, whatnot, but most of it is just an echo of the overheating and the pandemic housing boom and the echo of the inflationary shock we went through. And so that's been hitting a lot of homeowners, right? And they were kind of surprised by the size of some of these bills. And then property taxes. And property taxes is a little bit more nuanced because how it feeds in varies a lot across the country. And so you have some states where, this is still going to, the overheating in prices in 21, 22, it is still going to be a story for property taxes in some of these markets 27, 28, all this inflation that's occurred there. And so, I think a good number of these homeowners were a little bit shocked at the carrying cost that have went up for them uh, due to this overheating that's occurred in the market.
Well, let me tell you another scenario that I'm hearing more often. Home buyer buys a home. The lender knows the insurance agent and says, hey, call this person. They do a lot of my clients' policies. They underwrite the policies. They are quoted the policy for the house. Home buyer buys the house. Couple weeks or months later, they get a letter in the mail. Apparently, the underwriter or whoever was evaluating their property said, your insurance is going to be canceled unless you put a new roof on your house or unless you redo the front porch or whatever, and hits them with this requirement where they have to spend a lot of money or their insurance is going to get canceled. And you know what happens then? Their mortgage company gave them the loan on the basis that they'll keep the asset, their house, covered with a homeowner's policy, that in the event something happens, the mortgage company doesn't lose. So then if the policy gets canceled, the mortgage company finds out about it and puts a high risk policy on them. And this is kind of like some of the things that we're seeing right now.
Yeah, we have seen a notable uptick in non-renewal rates. And I think of the publications in the country, I think Resi Club's one of the few that's really covered this down to the county level. And if you go through parts of coastal North Carolina, all of Florida, essentially, all of Louisiana, those markets have seen a really big uptick in the non-renewal rates where, you have for whatever reason, and some of it's like what you had mentioned, and then some of it's that these insurance companies have either pulled out of the state or, they've had to shift their own internal policies. But this insurance shock that we've seen in the market, which is an echo of the pandemic housing boom and overall US inflationary shock, is also creating a shock for non-renewals, a big spike.
Hmm, interesting.
And it's become a little bit of a harder issue for some buyers out there trying to find policies. And one of the last things I want to cover here is just because it is so important is active inventory across the country. I'm one of those ones who loves to cut active inventory and compare it to 2019 levels. I understand that in some markets, if population kind of moves up over time, that 2019 comparison people think might be less valuable. But I'll tell you what, right now, this analysis, this data cut of comparing inventory now to 2019, it's been super effective in terms of finding market softening. And if you're a market like Punta Gorda, or Austin, where you have 60, 100% more inventory today than 2019, that's a market that's in correction mode, right? That market's correcting. And you look at Denver. Denver's one to really keep an eye on. Their inventory has built from 5,000 in July 2023 to now they're over 13,000, and that's comparing the same month, July. And so that's really a market that's softened there.
Hmm.
There's now 48% more inventory for sale in Denver than 2019. Of course, keep in mind, this is a much more affordability constrained environment than 2019. Markets like Memphis, uh, that's a market, and Nashville and these pockets of Tennessee, and even into some of the parts of Carolinas are seeing notable inventory growth that is suggesting that prices in the next 12 months are going to soften more and greater declines in those markets, in my view. Just we saw this story play out a year ago in Tampa when Tampa jumped from 8,000 to 16,000. We might even have had the discussion a year ago. I can't remember, but Tampa was signaling that there was going to be a lot of weakness in 2025 based on their inventory data 12, 18 months ago. And that pricing weakness has now manifested into the market. And a lot of Tampa is passing through outright home price correction.
And what you're showing here doesn't even reflect the amount of delistings that we've seen because a lot of sellers have taken their homes off the market in the last month. We've seen a lot of contract or listing cancellations. So, Lance, can you do you see any more or less activity on the investor side of purchasing? People buying for, especially in these newer communities, absorbing this inventory that's out there for rent inventory? Are you seeing any movement there?
What we're seeing on the investor side of the market is that everybody, first time buyers, investors, everybody pulled back when 2022 occurred, right? Now, in terms of a percentage, investors are kind of maybe up a tad when you look at the percentage. But the thing to keep in mind is that there's a denominator effect on the number where we're missing 1.3 million existing home sales. So every category of buyer has pulled back. Just the percentages and the shares, for one group or another group might be a little higher. But the big thing to keep in mind is that everything is pulled back because that overall existing home sales level is pulled back. And so in the investor side, we're still seeing some investors out there buying. They have, more interest in some of these markets in the Midwest, in the Northeast, these secondary markets, Syracuse, Allentown, right? Cleveland, some of these places they can still find a little bit of cash flow. That's where more of them have went recently. But we are also starting to see more dispositions. Some of these investors who are doing the numbers and they're looking at their carrying costs going up from property taxes, from insurance in some of these markets. And they're like, you know what? The math isn't working as well. Maybe I take this, sell it, and put this money somewhere else.
Yeah.
Some of the other investors that are selling, some of them bought Airbnbs, right? And they didn't quite understand what they were getting themselves into. And then you had some people who were newbie landlords who bought during the pandemic boom. They heard about it, all these different places. It was this next way to get rich quick, they kind of felt. And then they got into it and they're like, you know what? I don't want
This
to.
sucks.
No, this is not a passive investment, right? And so some of them are selling. And so you are seeing some of those dispositions. A lot of the institutional groups aren't necessarily selling off huge amounts of their portfolio, although you do have a couple like Vinebrook, but more of them are doing, but more of them are net sellers, right? Where they're buying very few homes because not many of them pencil, and they're selling off some of their underperforming assets, doing some dispositions. You also had some business models like the divvies of the world that were rent to own. And then that was also like Home Partners of America. And so some of those business models that really took off during ZERP, they're not doing as well now. And so you're seeing some bigger dispositions there. But overall, I would describe the investor side of the market as having pulled back, but having pulled back to a similar rate as we've seen in the non-investor buying side. But you are starting to see some of those dispositions, and more so in some of these markets, and even some of these different groups. And I'm going to have a piece out here soon. Some of these bigger investors who are selling, they're copying what the builders are doing, and they're doing some of their own buy downs, right, to kind of help to find buyers because this overall market is softened and weakened, and they're having a harder time getting the price that they thought the home was worth. And so that's kind of where I would describe the investor market at the moment.
Well, you definitely have your thumb on the pulse. What's the expectations for the next 30 days for what we'll talk about in September?
I think the number of markets that are falling year over year, I expect that to continue to rise. You are seeing delistings rise in some of these softer markets. I think some people are looking at that and looking at the decrease in some of the active inventory and some of the housing bulls, or maybe thinking that the market's tightening. And while I'm not like, you know, a big time bear or anything like that, I don't look at this data and see delistings as a sign of tightening. I actually see it as a market that is soft, right? Because if the sellers aren't finding their buyer in the market and they're having to delist, that doesn't mean that that market has suddenly tightened up. And some of those sellers are going to come right back to the market in a few months and are maybe waiting for next year's spring, kind of maybe thinking that rates will come down, thinking that the market will be tighter next spring and then listing. Now, whether they're right and whether that actually, the market is tighter or stronger next year, which is not my view at the moment. But regardless of who is right there and what 2016 looks like, 2026, that seller, many of them are going to come back to the market, right? And so just because you see a delisting or a drop in inventory during the seasonal period where active listing starts to roll over, does not mean that active listing is not going to continue to rise into next year. And when we go back into the seasonal swing, when inventory is rising.
Yeah, and those new sellers or those sellers coming back to the market in the spring may be more desperate to sell than they are today. Well, Lance Lambert, thank you again for coming on the show as always. And I encourage everybody, check out Lance's links, follow him on X, subscribe to his newsletter, and we'll see you next month.
Awesome. Chat soon.
Thanks so much for watching. If you like the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.